So quickly about myself. So as Todd said, I'm a lawyer. I'm based in Silicon Valley, and I represent startups and I represent venture capital funds. So that's all I do. I've been doing things for about 15 years. So I saw the original .com crash in 2000, the 2008 recession, and sort of the things picking up in the last couple of years. So I've seen this all. I've probably had over 450 startups that I've structured. Of those 450 startups, maybe 25 are successful. So it's a tough business. It's a tough business. They say about 10% survive. I don't think so. It's probably 5%. On the other hand, every startup founder I've ever worked with became successful. Everyone, and we're talking about several thousand people. Not a single one did not become successful. So the startups fail, founders still become successful. So don't give up. Now, my good friend Val has covered a bunch of my presentation in his own presentation. So I'll just go very quickly through my slides because a lot of it repeats what Val has said. Now, what do I press? Okay. So we're going to go very quickly. Okay, so 2014 was a real good year. Highest year since 2000, almost $50 billion invested in startup companies. That's a lot of money. Most of it is Series A. Series A is dominating. Series B, there's a lot of Series B activity. There's a lot of Series C activity. Series D, Series E are kind of dragging behind, but still you can a lot of Series D and Series E rounds, and that's because it takes longer time to get to an IPO, to get to an M&A event. So 15 years ago, companies would do an IPO in 3 years. Now it takes about 8 to 10 years to do an IPO. Now this is really cool stuff. Now, what are the median pre-money valuation of a startup? And this is based on Silicon Valley. If you want to talk about Ukrainian startups, you can cut this number by 2, maybe 2.5. Silicon Valley has very high valuations. So you can take a look. So in the last quarter of 2014, Series A was about $10 million valuation. Now, what does it mean? What does this actually mean? That the valuations are growing, and mostly it's because companies are raising money later in life. So they might raise a small seed round, and then they wait for about a year and a half, and then they raise a bigger Series A round. So they don't raise a seed round and then go straight to Series A. They actually build a product, get some traction, get customers, and only then they go for the next round. It's a pretty good lesson. So you want to raise your money as late as possible, because that way you raise at the highest valuation and you give up the least amount of shares. So here's the median amount of money raised in a round. So Series A, people are raising, about $3 million now. And look, about 3-4 years ago, it was under $2 million. So big Series A rounds. Series B rounds, we're talking about, close to $11 million now. Series C rounds, we're talking about $12 to $15 million rounds. Now, this is a really important slide for you guys. Let's take a look. Here's how many shares, what percentage of the company the founders retain after the Series A round. Now, this is Series A round. This is not the seed round. So, last data we've got is after Series A round, the founders retain about 75% of the company. Now, this doesn't include the stock option plan, which is about 15%. But after Series A round, founders usually retain about 60 to 65% of the company. What does it mean? If you're raising a seed round, and like a lot of people in Ukraine, they raise a seed round and they give up a third of the company, that's going to look really bad when you're raising Series A round. Because this is what the investors want to look at. That's what they want to see. They want the founders to retain control of the company at least until Series B round. So if by the time you come to the Series A round, you already have given up 30% of the company, and you give up another 30% of the company during the A round, and you end up with having less than 50% of the company, you're in big trouble. And a lot of Silicon Valley investors are not going to invest in you. And this is actually a very big problem that I see for Ukrainian startups. Ukrainian startups tend to give up a lot of money, a lot of value in the company very early on. So they raise, let's say, a $250,000 round, and they give up 40% of the company. Then they come to the Silicon Valley, the company is doing well, and the new investors see the cap table, and they see that the founders now own 50% of the company. And they say, wait a minute, so we're going to take another 25%, and then the founders have no incentive to work because they don't own the company anymore. The investor owns the company. And then you have to come to the Ukrainian angel investors and tell them, listen, the company is going to go under unless you give up 1% of your equity. And it's not easy to do. So my advice, try to negotiate for the best terms. You can tell your investor, you can tell angel investors here in Ukraine or Russia or anywhere that if you guys want to take more than 10-15% of the company during the seed round, it's going to make our life much more difficult when we're raising the Series A round. So that's probably the most important thing I want to tell during this conversation. So this is the stock option plan. Stock option plan is 15%. That's the median. You can try to keep it at 10%. It's hard to do it under 10%. So you want to keep it at about 15%. So when you start the company, when you first incorporate the company, if I were you, I would set a stock option plan at 10%. When you're raising money, then you might want to bring it up to another 5% to make it 15%. Investors who want you to reserve 20-25% for stock option plan, that's not reasonable. Founders who want to have like a very tiny 5% stock option plan, it's not reasonable. You're going to look stupid in front of Silicon Valley investors. Now, this is, we're talking about Series A valuations. They all depend on the industry, right? So the, life sciences, pretty big valuation. Clean tech, very low valuation. People don't like to invest in clean tech anymore. Now, it's different for bigger rounds. So these are rounds over $2 million. So internet, software, these are really leading the pack. Life science, clean tech, still at the very end. Oh, this is good. So look at the number of up rounds and down rounds. Really, things are really improving. In 2010, we had about 30% of down rounds. Now, I don't know, it says about 5%. Actually, I haven't seen a down round in the last 2 years. So things are really, really improving everywhere. Of course, it depends on the round. If you went all the way to a Series E round, chances of having a down round are much higher than if you're raising a Series B round. So in Series B rounds, very few down rounds. So like in 2014, we had about 6%. So things are really looking good. So when an investor comes to you and says, well, we're going to invest money in you, but at a smaller valuation than the previous round, it's not reasonable. In this environment, it's not reasonable. Oh, here's another good slide. Here's when you raise rounds, you want to raise rounds at a high valuation. Some companies are very lucky. They can raise Series A round at $10 million valuation, and they raise a Series B at $100 million. That doesn't happen very often. That's an outlier. So usually, if you raise your valuation between rounds at 2x, you're in really good shape. So if you have a $10 million Series A, 20 million Series B, 40 million Series C, you're doing really, really good. So founders who want to raise rounds at much higher valuation, they raise a 5 million Series A round, and they want to do a 40 million valuation Series B round. It's not reasonable, not reasonable. So if you do 2x, you're in good shape. Okay, seed round investments. So 2014, like Val said, very, very busy year for seed round investments. Over 1,000 financings. I think about $1.5 billion. So good news, right? Well, not exactly, not exactly. Because, well, I think I'm skipping. Here's what happens. A lot of seed rounds are raised, but not that many Series A rounds are raised. So I have statistics, I think it's one of the slides which I'm going to come to, but they've done studies, and of the companies that have raised Series seed financing, so seed financing, only about 25% went on to raise the Series A round. What happens to the other 75% of the companies? They're dead. Most of them are dead. So it's a lot easier to raise a Series seed round than to get a Series A round. It's not difficult. Well, it's not very difficult to raise, a couple of $100,000. It's very difficult to raise $5 million. And everybody tells you there's so much money out there. Best year since 2000. Yes, but it's still very difficult to raise money. It's difficult to raise money here. It's difficult to raise money in Silicon Valley. So a lot of people, hear this, look at the statistics. They get on the plane, come to the Silicon Valley, and expect to raise a nice round in the first 3 weeks. Doesn't happen. Doesn't happen. It really doesn't. I would say, in my experience, my personal experience, for every 10 companies that are looking to raise a Series A round, maybe one actually successful. So don't give up, but the worst thing you can do is to come to Silicon Valley without any preparation in hopes that people will throw money at you. Doesn't happen. Unfortunately, it doesn't happen. So yeah, Val was they're talking about this as well. Who invests in seed rounds? A lot of VC funds now invest in seed rounds. Used to be just angel investors. Now it's professional VC funds. This is also interesting. A lot of people, for instance, in my experience, I work with a lot of Ukrainian startups and Ukrainian investors. And a lot of them haven't heard of a convertible note. And most seed financings are done using the convertible note. The numbers here I have is about 70%, 30% of all seed rounds are done with the convertible note. Now, that doesn't sound very much, but if you take seed rounds under $1 million, it's probably 80%. So 80% of all seed rounds under 1 million are done with convertible note. The bigger ones are done your seed round could still be up to $2-3 million. The bigger rounds are done with a stock sale, but small seed rounds under $1 million convertible note. Again, if your investor tells you, hey, we don't want to do convertible note, we don't understand what a convertible note is, and it's going to be a tiny, $100,000 round, it's going to make it a lot more difficult for you to raise the next round in Silicon Valley, because Silicon Valley investors want to see a clean, nice cap table. They don't want to see preferred stock for very small amounts. So anything under $1 million got to be convertible note. So you got to convince your investors, got to be convertible note. So that's the slide I was talking about. So the seed rounds are really, quadrupled from 400 to about 1,800. The Series A rounds, they increased about 50%. And the companies that don't raise rounds, Series A rounds usually die. So 27% that raised a seed round in 2011 did not, only 27 raised a Series A round. The rest of the companies, unfortunately, are dead, and many of them are my clients. So this is sort of, what are the seed investment terms? And I will go quickly to which I think is the convertible note, which I think is important. Interest rate for convertible note is 5.5%. I've seen it 6%, I've seen it 7%, I've never seen it more than 7%. If an investor wants a 12% convertible note, that's unreasonable. Maturity date. You get a convertible note for about 18 months. 12 to 18 months. I've seen 2 years. I've never seen longer than 2 years. I've never seen less than 12 months. Now, I don't know if you guys know much about convertible notes, but you usually get to convert your loan into shares at a discount. And the discount is 20%. That's the standard discount. I've seen 25%. I've seen 18%. I've never seen more than 30%. So you guys want to go for 20%. That's the market standard. Valuation cap. Again, valuation cap. Most convertible notes have a valuation cap, and the median valuation cap in Silicon Valley is $6 million. You know what the median valuation cap in the deals I've done in Ukraine? $1 million. So the terms in Silicon Valley, especially for convertible notes, are so much better than here in Ukraine. So you want to argue with the investor for a much nicer valuation cap, keep it at least $3 million. Oh yeah, a lot of Ukrainian investors want to have a seat on the board of directors. So they invest $100,000 and they want a seat on the board of directors through a convertible note. Doesn't happen. 2% of the deals, the investor gets a board seat. Only 2% of the deals. Well, this is more complicated stuff. That's probably I don't want to bother you guys with. So I think I have only 3 minutes left. So if you guys have any questions, just let me know. Otherwise, thanks a lot for listening.